Good afternoon. My name is Amy Charles. I'm from Raymond James, and I'm the head of closed-end fund research with Raymond James. I've been there for 29 years, I think, this week. So I'm a franchise player is how I put it. And I know a lot of my colleagues have been all over the place, but my card still says Raymond James. I'm going to let each of our panelists kind of give themselves a quick little commercial, and then we'll get started.
Stephen Menard. I'm at BlackRock. I head up our closed-end fund product team. I've been there for a little over 9 years, and I've also spent pretty much my entire career in closed-end funds, previously at Morgan Stanley, both as a research analyst and as a banker launching new funds.
Hello everyone, my name is Stephen Davis. I'm a closed-end fund product specialist at Nuveen. I work with our internal US wealth sales teams, and I assist them in their conversations with their clients on all things related to closed-end funds trading in the secondary market. Relatively new to Nuveen. I've been at Nuveen for about 2.5 years, but I've spent most of my career in closed-end funds. I worked in London as an investment company's analyst in the UK trust market, and then before Nuveen, I was responsible for the sales and trading of all US listed closed-end funds at Cantor Fitzgerald.
Andy Hall with NASDAQ. I've been with NASDAQ since 2004. I've been on the new listing scene since 2007, and I work with all manner of new listings to NASDAQ equity listings, which includes closed-end funds and BDCs. Thanks.
Great. I think this is a very closed-end fund heavy panel versus BDC, but if you guys have questions, Andy can answer it. The rest of us can't.
I'll try.
Or, we'll figure out some kind of answer. The first thing that, as an analyst, I'm always looking at is, and I'd like to think of as aftermarket research, and where you guys think that the importance of aftermarket research. And I think probably Stephen, our twin Stevens there, can answer that probably best. So Menard, we'll start with you.
Oh, thank you. I think the aftermarket research is really critical because there's a huge push when you launch these products to drive demand at the IPO, and then in the secondary market, you need to drive additional demand for those shares, and we try to do that from our side through our wholesalers and through my team that supports these products. But I think it's really critical, especially at those large banks that are underwriters on these offerings, that they're out there providing that research to their financial advisors in terms of the ongoing performance. And then special considerations around discounts, taxes, et cetera, just to keep people updated on the funds. Unfortunately, I would say in the recent past, since really the 2.0 structure, and we can get into what that means, but since basically 2019, a lot of those IPOs are not being covered at some of these firms, and that's left the void to, again, just on basically the asset managers to provide that to provide that research. And so we provide things like quarterly commentaries on all of our funds that we've launched since 2019. But again, we'd love to see an increased support of these products in the secondary market, from individuals like Amy.
Yeah, I would just say that at Nuveen, we believe it's vital to support closed-end funds in the secondary. I work with a number of colleagues and other product specialists. We, as I said in my intro, we are on call and we support our US sales teams in their conversations. I keep our US sales teams abreast of what's going on in the market in an internal weekly piece, and we also produce a monthly commentary to keep advisors aware of what's going on. I'd agree with Stephen. There's been, we need to support all closed-end fund investors, not just at the IPO primary stage, but throughout. And it's been a quiet market, obviously, in the last couple of years, and we've put resources into supporting our clients and help them navigate the market. And that's where we've been putting our resources.
Great. So we talked about, Steve mentioned 2.0. So with the new issues, that's always been a big question I keep getting. Are there going to be new issue closed-end funds? And if so, will they ever go back to perpetual, or will stay with the 2.0 with the terms? And so I think that, Andy, I'm going to get you in on here too to see what you see in the marketplace.
Yeah, sure. I'll jump in here. So just to explain for those who may not be familiar, the 2.0 IPO structure just basically references the time when we changed a few things. One, we added limited terms to these funds. Typically, closed-end funds have historically been perpetual vehicles. The other major change was how the fees were charged up front. Typically, in the old 1.0 structure, those were removed from the fund at the IPO. So your $20 market price or IPO price was about 1906 NAV on the first day. Again, that 4.5 or 4.7% spread, was coming out of the fund to pay the selling concession for the advisor, the underwriting fees, et cetera. So now today in the 2.0 structure, all of those fees have been removed. So your $20 IPO price is now also a $20 NAV at the start. That has significantly improved how these funds have traded out of the gate. But I think to maybe differ a little bit from Finbar, I don't necessarily disagree with you. I think that we are in a healing period. I think we might need to start where we left off. But I also challenge the fact of what is the term really providing to the end client, right? I think when we've launched these funds, one of the other things that we've tried to do is really democratize access to private markets. And if you're putting illiquid assets in this vehicle, you also have to think about the liquidity constraints, when it comes to that term. And so, unless if the term is there to manage the discount, well, honestly, I don't think we're necessarily seeing that in the market today either. I think some of the things that we've been trying more recently are ideas like discount management programs, where you have a conditional tender offer on the discount, right? And so in our case, we do that on a quarterly basis. If the discount's greater than 7.5% during that calendar quarter, that triggers a tender offer. I think something like that, maybe not necessarily quarterly, maybe it could be annually, but that could be more interesting in the new, what we call maybe 3.0 wrapper, that we're, at least some of the things that we're considering on our end.
Yeah, I'll just add to that. I think Stephen's right. I think the term structure has become something that has become somewhat accepted. It does have a role, and it can help investors match a liability if that suits the asset class in which the fund is investing. It can help narrow the discount, although you only tend to see that towards the end of the term. I agree with Stephen. I think we're going to see, we might be in a situation where we see the structure evolve to incorporate some other liquidity measures, be they tenders or some sort of trigger at a certain discount level. So it's tough to say. I would say that we might see some more term funds, but only if they sort of suit what the asset class is trying to do.
Yeah, maybe I could, sorry, not to extend, but
No, I was just chime in here because
I think when it comes to terms, there are certain types of products that a term makes sense, right? So right there, I think a term certainly makes sense because there's a defined life and there's an objective associated with it. But if it's meant to, again, mitigate the discount or manage the discount, well, then you need to see proof that it actually works. And I'm not seeing that in the market today.
And I'll just punch in here real quick. I think the funds that have term or defined term in the name tend to trade a little bit tighter than the ones that don't. Because if it doesn't have it in the name, and I know closed-end fund names are extremely long as it is, just your normal advisor or your normal investor doesn't realize that it's a 2.0. So I do think that. I think that it's also a very big marketing tool when you're trying to sell closed ends, or on my side when I'm researching them. Okay, this is at a 6% discount. It's going to liquidate in 3 years. That's a nice little discount or a nice little thing that I can recommend to advisors. Andy, I'm going to get you involved here. I told you I would. So when you're listening to this, especially with the new issues, have you gotten any kind of feel of where the market's tipping towards? I mean, are they going to go more towards NASDAQ? Are your fees cheaper?
Right.
Can that help alleviate some of the, fee constraints with the funds themselves, and now with the fund companies having to outlay that initial money?
Sure. I mean, the listing fees on NASDAQ for closed-end funds and BDCs are quite low. It's actually lower than our normal common stock listing fee schedule, but the initial listing fee is only $5,000, and then the annual fee is either $35,000 on the low end or $112,000 on the high end, and that includes families. So you could have 100 closed-end funds, and they're listed on NASDAQ, and you pay $112,000. So of course, that's reducing your cost from a fee standpoint. From a trading standpoint, we all trade each other's stocks. We all have unlisted trading privileges. Obviously, closed-end funds, it's a big retail product, maybe only 25% institutionally held on average. So you've got a level of volume that trades in these closed-end funds, which might trade a few 10,000 shares a day or up to 150 or into the hundreds of thousands of shares a day. About 60% of that volume is being internalized. So the market makers are matching at their own desk. So 100 shares to buy, 100 shares to sell, they'll internalize it within Morgan Stanley, or they'll match it via dark pool. So then the other 40% of that volume is going to the exchanges. And if you look at the limit order book or level 2 quotes, you can see NASDAQ and the NYSE are equally trading that volume that's going to the exchanges, irregardless of listing location. A listing is a license. You need a transfer agent. If you want to be a public security in the US, you have to be listed on NASDAQ or the NYSE. After that, it doesn't matter. So yes, fees come into the subject, and then we also have some support services, no-cost IR services that we provide to the BDCs and closed-end funds for the first 3 or 4 years.
Great. I'm constantly getting questions from retail, because that's what I talk to. I talk to advisors all the time. They want to know where the trends are. And so I always look at inflows to open ends or ETFs about where the inflows are going, or outflows, conversely, to see where things are coming out of, which are going to be out of favor. Because inflows into open-end funds equals more narrow discounts or even premiums, and vice versa. So do you guys have any themes that you think are coming for the next, if the window opens, in 2025, what you're seeing, whether it be inflows?
I would just say, I think whatever comes to market in 2025 is going to sort of be, to a certain extent, dipping the toe back in, right? It's been a very quiet market. I think there's been a lot of healing to be done, but the market has improved. We've seen significant inflows into closed-end funds this year, renewed interest, in the closed-end fund market. As interesting as that sounds, discounts have really, really tightened in this year. So the scene is set, and I think we will see some issuance next year. I think it's going to be something that investors are comfortable with. I don't think this is the market where we launch a triple levered equity CLO tranche closed-end fund. I think it might be something a little bit more vanilla.
Simple sales.
But I think that there's even within asset classes where there's already a closed-end fund, there's always a niche. There's always a different play on an asset class, and the structure can also evolve as well, just as an asset class can. So I think the market looks better. I know I would say that, but I think we're in a much better.
So we're not dead yet.
Yeah. No, the closed-end fund structure is definitely not dead.
That's good to know, because that's my job.
I think flows is certainly a great place to look. I also think you need to focus on where are the valuations in the market. And I say valuations because we often too often say discount, right? But not all funds trade at discounts. A lot of funds are actually trading at premiums today, and I think that's something that a lot of, particularly driven by the media and their focus on discounts and activism in this space. There's a ton of bright spots in the closed-end fund market as well. Wouldn't expect that from a muni fund. I think, again, some of this stuff goes unnoticed just because of a lot of the negativity that you hear in the media around the closed-end fund product. But like I said, there are a lot of bright spots.
Same with you. You were talking about trends, though, the equity trends versus BDCs and closed-end fund trends. I mean, what are you seeing on the equity side that could parlay into closed-ends and BDCs?
I mean, from a BDC standpoint, for new listings,
Yeah.
there were 4 last year closed-end funds, or this year, and 4 so far this year. So, I mean, 2021 was an absolutely banner year, off the charts for the broad equity market. In the U.S., $285 billion in offering raised for almost 1,000 listings, right? And that was also a good year for closed-end funds at 12 or a little bit more than that. So, and that's what we've kind of seen in terms of the trend of the closed-end funds in the early 2000s, where you had a low interest rate in market. You had 24 closed-end funds or more listing on the market. And then as the market if there was headwinds in the market or interest rates went up, then that became more challenging. Now we're seeing in more like a handful every year of closed-end funds listing on the exchanges.
Okay. All right, great. As far as kind of going back to some of that aftermarket issues, consolidation, either making them into interval funds or consolidating, similar funds. Do you see this as a trend going forward? And probably Stevens again.
So this is something that, it's been a trend, I think, for probably the past decade now. And I think part of it is driven by just how products are launched in this market, right? You need a new IPO to raise new assets. Raising in the secondary market is fairly limited given the constraints there. And so you end up with funds that have somewhat similar strategies. And so there's a lot of reasons to continue the mergers where you do have that overlap, simplify your lineup, make it easier for people to make decisions, right? If you're choosing a BlackRock muni fund, you should only have 1 or 2 or 3 choices, not necessarily. I think today we have 13 of the same strategy, right? So that's something that we've been focused on, consolidating. But I think one other thing, again, going back to the topic around discounts, because it is a very common thing that's focused on in this market. We've been trying additional tools to manage those discounts over time. I think if you just look back historically, a lot of this is just driven by rates. We've been in a very difficult part of the market here with rates going up. If you just look at the Fed funds rate over the last 25 years and you track discounts, there's a pretty high correlation between those two things. But it doesn't mean that we shouldn't try to mitigate those discounts, when they do widen out.
Great.
Yep.
You want to add? Go ahead.
Yeah,
You have plenty of time.
The consolidation. If anyone was at ICI yesterday, will remember that you've only got to go back 10 years, and we had over 600 closed-end funds. We're right around 400 now, and if you look at why that's happened, a lot of it is to do with mergers, and that's been something that the product teams have tried to do for the reasons Stephen explained. Lots of benefits of larger funds associated with economies of scale. We merged a number of funds last year in the preferreds and the loan space, and we think it's we think it's beneficial. Obviously, lower expenses, better access to leverage if you have, and better leverage terms. In terms of just to sort of build on what Stephen was saying, we've taken steps this year to address discounts. In addition to share buybacks, we've increased distributions to essentially increase the demand for the fund shares. That's had a dramatic effect. If you look at discounts generally this year, all funds have narrowed in, but those funds that have increased their distributions and returned some capital in their distribution have narrowed more. And we think that's beneficial to shareholders. There's, of course, an element of that is to stave off some activism. But this somewhat ties in with our outlook to do with rates as well. We think that declining leverage costs should reduce any reliance on return of capital in a distribution. We think those dynamics are in our favor. And of course, share price returns have been good.
Right. I'm going to put my hat back on, and I have a question for, I think the whole panel. When we do at Raymond James our national conferences, and I sit in a BlackRock meeting or a Nuveen meeting or a Destiny meeting, I know Rosie is in here, so I'm going to throw her under the bus a little bit. No one ever talks about close-ends. Not one person that the firms send to our meetings talk about closed-ends. There's not research on the tables, there's not giveaways that say closed-end funds. So a lot of the times, the only way someone on the FA side is hearing about closed-ends is when there's a new issue. And that's the only time that the wholesaler will talk about closed-ends or at a conference. Is there anything that we can do to fix that? I mean, I'm at my conferences talking about closed-ends. I mean, if there's a Raymond James financial advisor in here that does not know that we have closed-end fund research, meet me outside because I'm going to beat you up. So I think that closed-ends are sold on thought, right? We all know that. So how do we get it to where people understand what value the product brings? I always say that it's the clearance rack of the investment world, right? I go to the back of the store, I get what's on sale, closings are on sale. The alpha that you can generate from your clients, I think is much better. And it's the same portfolio managers, right? So is there a way to where you can at least just have a 32-second plug, or have the people who are going to the conference that are speaking talk about it in some capacity? Not everybody answer it like that.
I can start off. I mean, like I said earlier on, we sort of pride ourselves on, giving the best resources to shareholders. Our website, nuveen.com website, has a ton of resources from, closed-end fund 101 to understanding managed distributions, understanding leverage. Myself and a number of colleagues support our teams, our sales teams. So we want to educate the wealth advisors on closed-end funds. We obviously believe in closed-end funds. We sort of live and breathe them. We think they are an incredibly attractive product for investors looking for reliable, high income. So, it's something, the secondary market is important. And we do everything we can to educate and support.
And I think everybody that uses closed-end funds knows about CEF.
Right.
Everybody. But if they don't use closed-end funds, they have no idea what it is. They don't know and that's what in BlackRock's the same way. There's great information if they start looking, but how do we tell them to look there? That's the question, is how do we get more people to look there?
Yeah, I mean, NASDAQ tries to support all its new listings and continued listings. We have a very nice facility there in Midtown where companies ring the bell, but not only that, we have a full PR team to kind of set up interviews with that new listings CEO. So the same could be applied to that closed-end fund, and then some great event space in terms of them doing an investor meeting or even having a forum on closed-end funds. And that's all part of the listing experience. We're not adding additional cost to the issuer there. And then in addition to some investor relations tools that come at no cost for the first couple of years with the listing to help with investor targeting as well. And all that's for any issuer, regardless, common stock, BDC, closed-end fund.
I literally looked in the paper for the previous week's NAV. They were deleting it. So things have grown so much. But it's more of just, I think what maybe 25% of the financial advisors even know what a closed-end fund is. Because they're never going to hear, I heard about this great closed-end fund at a cocktail party last week. What can you tell me about it? So it's out of sight, out of mind. And I think that's just getting into the branch offices, you know, and how do we do that? The best bet is have your wholesaler just leave a tear sheet. If nothing else, I don't talk about it, just leave a tear sheet. And so I think that I do think that would help matters. I know they're not going to get paid on stuff. I get it. They get paid once, but it might open a conversation with that corner office guy that they didn't have before. So it could be profitable all the way around. But that's just me. All right, we're getting close to time. Anybody have questions? Yep.
Product development question for the three panelists. Let's say a year from now or 5 years from now, we're talking about closed-end funds 3.0 instead of 2.0, and you had to limit it to just one additional key feature that was added to that 3.0 product. What would be that one thing we're talking about 1 or 5 years from now? We're talking about closed-end funds 3.0 with the three product development.
I mean, I think, you know, we're still seeing, you know, we're still assessing the impact of this, but I do think, you know, some sort of regular liquidity mechanism at NAV more frequently than 12 years is something that you'll see in the product.
Yeah, I would agree with that. You know, I think some kind of liquidity measure, you know, we're probably going to follow the path of the London market, which has been more, you know, robust in its discount control mechanisms from the get-go, from the IPO stage. Shareholders have come to expect some kind of discount control, whether it's a tender offer that's triggered at a certain discount level. But I think that's probably going to be, if there is a 3.0, I think that's what it would be.
How about
2.5.
How about lower underwriter fees?
We're not a not-for-profit business.
The industry should lobby the SEC to get rid of the prohibition on performance fees, because I think a lot of top managers that we read about in the Wall Street Journal and so forth are much more, they're going to be running hedge funds that are not so restricted. And that's why Bill Ackley moved his hedge fund to Amsterdam, where they could get a performance fee. So I think, I don't really understand why you can't have a performance fee, but I think that would attract these high-profile managers, and that might be, maybe not $50 million, but to start a fund where they really have the reputation and publicity. It's people who think outside the box and can perform, and if they can start a closed-end fund, might jumpstart the IPO. So that's my 2 cents. Maybe there's a comment about it. Does anybody know why you can't have a performance fee? Yeah, I don't really understand.
I think because it's a 40 Act retail product, and so there's no, we don't have the, you know, credit or, you know, we don't have any of those complications around it, so anybody can buy it.
Yeah, you would have to be a qualified client in
Yeah,
order
that's
to.
the word.
Right.
Well,
So you, yeah, no, no comment on.
well, thank you, and thank you, audience.